some people are calling me going, my amortization is like about 108 years left to pay off my mortgage because they were in a low variable rate that wasn't moving. Right? Well, it looks bad, but when your renewal comes up, it's very easily you can get your amortization back. I mean, amortization can be manipulated. I don't mean that in a bad way. I mean, when my renewal comes up, I can just change my amortization to higher or lower, therefore manipulating the payment. It's nothing wrong with that. That's just a part of the process.
Yeah, you get that booming voice. Dave Butler, we are live, brother. How you doing?
Very, very, very good. Very good. It's a nice drive in, eh? It's just like for me, I'm coming in from Ancaster, so it's just 407, like the entire, it's just like a nice peaceful drive.
I love that. I love that 407. Listen, man, when I need to get across the city, I know they were talking about, we should open it up and not charge. No, not charge. Because I want to know that I can get across the city when I need to get across the city.
Well, and there's an extra reason you and I love it a lot, and that is because we have cottages in Kawarthas.
That's right. We're neighbors up there, Lakefield.
Yeah.
That's right.
I mean, when I bought my cottage in 2013, I remember that the choice was you're looking at cottages, and so you're like, okay, the main two cottage areas, obviously, for Southern Ontario folks is Kawartha Lakes or Muskoka, obviously.
Yep.
And I just remember at the time, 2013, the 407 wasn't done. It was probably, it had only actually gone probably to Markham. It wasn't even like going that far.
Yep.
But the projection was that it was going to go all the way to Highway 115, which, as you know, takes you to, you're only then half an hour out from, not even 20 minutes out from Peterborough. And then, of course, north of Peterborough, and that's where all the cottage countries all start.
Yeah.
But
and that's one of the reasons why I moved to Peterborough. Because when I saw that artery going right across the top, I'm like, okay, boys, let's go. We're going to Peterborough right now.
Well, you're smart, because that was part of my decision making was, look, 400, even as a kid going up to your buddy's cottages, it was like, that was a bad drive. You know what I mean? Like sometimes you're leaving at the wrong time. You're like 4 hours in traffic. It's gross.
Yeah.
And it was like,
and there's only like one artery to get in, and it just bottlenecked right
There was no such thing as the 400 times 2 coming in. It was like, that's it. So as to your point, it's like they're opening up a main artery that's going to go, to the direction of the Kawartha Lake. So aside from the fact that whatever cottage you were looking at in Muskoka was double the price of the cottages in Kawartha Lakes, there was that too. And for those that don't want to be stuck in 4 hours of traffic, but they want to get to their cottage in about 2 hours or less, that created, and it was crazy, because I remember over time you're just waiting for the 407 to complete. Like they would just finish like a kilometer or two. You're like, come on, man, let's get to the end so I could. And because you'd have to get off it, remember, and then detour your go all of these back roads.
Like a million ways to get up there. But listen, Dave, man, there's a lot of things happening right now in the market. I want to dive into it. So we're going to do this in 2 parts. The first half, I want to talk about all the new mortgage rule changes that have been happening. I want to touch also on like a market update, your thoughts on that, and then also what new programs are out there. So let's kind of dive right into the new mortgage rule changes. So there's something happened on December 14th. There's actually a couple things that are happening on the 14th. And the first one is the new mortgage insurance now is going up to $1.5 million. What are your thoughts on that? Like, I mean, is that going to cause, I understand what it's doing now. It's opening up, obviously, for more people to get into the market, but what are your thoughts on it?
That makes sense. I mean, look at most, I don't want to say most, but look at a lot of pockets of properties in British Columbia, even now a little bit in Alberta, and look at a lot of areas in Ontario, right? I mean, a lot of homes that a family would want to be in certain areas, are now priced over $1 million. And, it was a bit of an interesting rule that, was applied many years ago. But then as price values were going up, the values of homes, were going up, they weren't making these changes. So I think it's a necessary change just based on the fact of where we are with pricing in certain areas. But will it be some explosion? I mean, no, look, it's still at the end of the day, properties over $1 million are still considered, not as affordable properties. And so there's not, your average family, maybe let's say, doesn't afford that. So, it's not like it's going to blow the socks off, but it's certainly for someone who's living in an area, let's say I'm in an $800,000 home in an area near Toronto, and I really want to get to inside of Toronto, and that's where I want my kids to grow up, and the price of that home that I want to buy is $1.2 million. Well, previous to that, you had to have 20%. So you'd have to have $240,000 to be able to get into that home. Let's even say you have a lot of income. Let's say your wife, is a teacher making good money. You are, let's say I'll call it a fireman or a police officer. You're making, and your family income is around $250,000. But if you don't have that $240,000, how are you going to buy that home? So now that situation, if they didn't have the down payment, how are they going to do it? So now they are in a situation where they can buy that place for $1.2 million, and on 1.2, your minimum down payment on that's only going to be $95,000.
Right. So, or even if you go up to the max of 1.5, you're about 125,000, and it would have been 300,000.
300,000. Yeah. It's a
huge difference.
It's definitely a big difference. It's going to be helpful. I mean, look, there's also families that are probably listening to this, or people that are listening to this, where you're like, I don't even own a home, and so how's that going to help me? Because I'm only looking to buy something hopefully around 500-600, so it doesn't matter. And there's also families that are like, well, that's beyond what I would be buying anyways. But so I say it's not for the masses, but it's necessary, for where our market is going.
Would you also say that this is potentially a bailout for the new builds and condos, where people now had to put down that 20% for a home that was over $1 million, and now they had to put down 225,000? It's now lowered significantly.
Look, I think you're going to find a consensus amongst a lot of different things that are going to pop up, and a lot of different changes are going to pop up, and there's going to be a back end part of it where you're going to go, oh, this helps the new construction, because to be fair, we are going to be in a new construction drought for a bit of time. In terms of completed projects, we're already in the drought, but the general public doesn't feel the drought until years later, when the homes that they expect to come to market don't come to market. Right. And that's, I think, when I've looked at, the data that I've looked at shows, 2028, 2027, 2028, 2029, depending on the type of property, as being years where we're not going to have a lot of new stuff coming online because builders have kind of stopped building. So to your point, and I think as we talk about even the other rule change, as you're mentioning, these are helping builders. Well, look at the other change. The other change that's being enforced on December 24th is that, or December 14th, is that you now can get an insured mortgage and get a 30-year amortization if you are a first-time home buyer, or if you are buying a new build. So again, back to what you say, I think you'll find there's a lot of these programs are going to come out that you're going to see in the back end are going to favor people that are buying new builds, but they have to do that.
Now, for investors, that does not apply to them. They cannot get that.
No.
Okay. Got it.
No, you can, in theory, and again, you can buy a secondary residence under the insured mortgage program, but you have to be very careful. The secondary home program states it cannot be used for rental. So, a secondary home program is actually most often used by parents that are helping either another family member. Yep. I've had lots of times where, hey, I want to help my brother and his wife out. They don't have the down payment and they need a bit of help with the cosigner. So I'm going to come in with them. And I've even had times where the people that they want to buy the home for can't qualify, but brother is going to buy the home for them. That's a true secondary residence. It's not going to be rented out. It's actually going to be for family, but also children, right? I can't tell you how many times I've had investor clients of mine come to me and be like, hey, my kid's going to school. I'm doing the math. It's going to cost me, X amount of dollars. Like, I'd rather just buy a place and then have my kid live there. I'll pay the mortgage for the 4 years or 5 years, 6 years, hopefully, if your kid goes to post-grad. And then I'm going to sell the house after and make a profit. And I'm like, that's a wise decision. I mean, if you're willing to get your hands dirty there and take that risk, then, the payoff can be big. And, I've seen it happen. I've seen people buy a home for their kid in Guelph or Hamilton area. The kid goes to school for 4 years, done. Parent sells the house, and in some cases, the parent keeps the house, turns it into a rental. But
I think that's such a brilliant idea. Like, so I just told you before that we turned the mics on as well too. So my son just moved out. He moved into one of our rental properties, and the way that we did it is that you move in, you stay there for 2 or 3 years, wherever the value of the home is, and whatever that mortgage comes down and whatever it goes up to, you can get that accordion piece or that equity piece and use that as your down payment. I'm not just going to give you the money. You got to go in there. You got to manage the other tenants that are in there, but I think that's a brilliant way of doing it for anybody listening. And the other thing I wanted to add on too was a 30-year AM. I think for anybody who's new, it used to be 40 years here.
Yeah,
I think a lot of people forget that. We're old school.
I was going to say, for the old schoolers, we're like, it's a muted response. For someone that's only been in mortgages for, say, the past, or real estate in the past, like 5 years or so, they're going to be like, oh, this is big news. I can't believe we get to go up to a 30-year. No, the reality is it would shock a lot of the newcomers to the industry if we were to tell them how back in the day there was 40-year AMs, there was 0% down.
Yeah.
It was they had some really wild programs, and they were making it affordable for Canadians to own homes. And excuse me.
Yep.
It obviously, some of that had, part and parcel to do with how values of homes ran up. But these were also, like, I liked these programs because they were enticing, they were helping people, and obviously, that's a stark difference to the past couple years where it seemed like we were really tightened, we were restricted. Bank of Canada had this restrictive high interest rates on us. Banks were cutting programs at very high levels to make it so that they really were de-risking themselves.
Right.
And I think, and I've talked about this with my couple of the people in some of my companies, is that I would expect, much like what we saw in the early 2000s, that this next cycle, however long it lasts, will be fraught with a lot of new changes, like we're seeing here in terms of government changes, but also banks. Banks are going to come out with programs, because once the banks know that we are out of the bad part of the cycle, they immediately try to take advantage of the upside. And we saw that in the 2000s. It was almost every year you were getting new programs coming out. Like 2002, here's this program. 2003, new program. Right. Always making it easier for people to qualify.
Right, and that's when you're starting to re-stimulate the economy, because that's what we need to do at this point in time. Well, at least that's what it sounds like that's what they're looking at and they're seeing it, right? So you're going to start seeing a lot more changes happening. So what about the stress test now? So is that in effect right now, where now if you have a mortgage at a bank, if you're BMO or TD, and that renewal comes up, the new change now is you can actually start shopping around.
Yeah,
can you touch on that?
This was a really, really good change.
Yeah.
Now you have to be very careful, because it's just when you're switching. Okay, so, and there's a big difference in this in our industry, so it's very, very important for the general public to understand. If I'm coming up for my mortgage renewal, let's say my mortgage renewal is January 31st, okay, and I'm coming up for my mortgage renewal, but on my mortgage renewal, I want to change my amortization. I want to increase my mortgage, maybe to pay out some credit cards or some loans that I have. Mm-hmm. The second you are changing any aspect of your mortgage on your renewal date, that is no longer a renewal, it's a refinance. Okay, so refinances are not sheltered by this new rule of no stress test. So that's one thing I want to get very out there, is because I get lots of calls like, all right, I got my renewal coming up here, there's no stress test, I want to change this. As soon as you say the word change, you are no longer admissible for this program. What it is, Gary, you've got a mortgage renewal coming up January 31st. I call you, we're speaking, and you go, yeah, Dave, I'm just looking for the best rate. I don't want to change anything. Mm-hmm. I don't want to change nothing. You now, when I do your application and I send it to the bank, there's no stress test. But I can't change your amortization. I can't change your mortgage amount. I have to take exactly the same mortgage you have now, but I can shop it to, let's say you're with TD Bank. I can go shop that to, say, Scotiabank as an example, and some of the other banks, to see if they will give you a better rate than what you're being offered.
Right. So now you're going to start seeing a lot more competitive rates.
Big
probably.
Time.
Yeah.
We're already seeing it. The calls that have been coming in for this, for this particular program, we've been sending out stuff to our clients in terms of monthly information so that they knew this was coming. But the calls we're getting are on a very high level.
Now you got to move it right before or right on the date of your renewal. The day of. Any hiccups, any issues that you've seen? Are people doing it now?
Always going to be hiccups when you have a deadline like that, because it's a very, very tough deadline. What it is you really want to be working with people that understand how this process works, having someone, working on your team that's experienced, that understands how this works, because there's a lot that goes on when you're doing a switch. It's behind the scenes. There's a lot of times not a lawyer. So switches are actually done because, and the reason why it's able to be done in a certain way is because when you're not changing the amortization, you're not changing. One bank can actually move the legal instrument to the other bank. So you actually end up, a closing service, usually FNF or FCT behind the scenes, is actually doing this. So there's no lawyer involved when you're doing a true switch. It's timing is huge, right? Okay. So what you want to do is, obviously, a lot of times, and we've recommended this to some of our clients, look, there's a chance maybe that when we're doing this, you don't end up closing on the exact day. And believe it or not, if you don't close on the exact day, your current bank is just going to lock you into something that's going to have a penalty. They want to do that, right?
Really?
Yeah, this is happening. I can explain to you a story that's happening.
So open, or lock you into like a 6 month open or something like that.
6 month closed, which is even worse. So
really?
so that's what the banks are doing if you don't tell them, if you don't communicate or sign anything with them and you're not closing on the exact day. So what we've been telling clients a lot is, look, just go to your bank, tell them you want it open for now. As soon as you sign with your current bank on an open, and mind you, it's going to have a higher interest rate. Like sometimes the interest rate's like 8 or 9%, but you're only going to have that open for like 1 or 2 or 3 days.
Right.
But it's really also, it's to protect you, because the worst thing in the world is, I've got your mortgage application approved. I'm switching you over to another bank. I'm saving you money. But the in the process of doing the switch, something that I can't control and you as the client can control, there's going to be a delay between the two banks, and maybe the bank that you're currently with is not going to get paid out till 2 or 3 days after your renewal date. If that happens and you're not in an open, your current bank, if you don't sign anything on your renewal, they just auto renew you, right? Some of the banks will auto renew you, as we talked about, into a closed program. That has a penalty with it. So imagine now you're going to go leave your bank because you have this 1 day every 5 years roughly that you get to leave and there's no penalty. And now, as soon as it gets done, you realize I just paid a $4,000 penalty because it didn't close on the right day.
Right.
So the only thing you can really do as a customer or consumer is protect yourself. Good brokers, good bankers are going to obviously give their clients the heads up. Hey, you should probably do this. Get into an open. Don't allow yourself to be put in this bad position. And it sucks because that's time out of a client's day. In a perfect world, as me as the broker, I could call the bank and be like, hey, put my clients in open. They won't allow that. Privacy Act, right? So
now, what about the other change? Now, there's another one happening in January 2025. January 15th.
Yes.
Okay, that one there, secondary homes. Let's talk about that.
Yeah, this is an interesting one. This will be on par with figuring out that other program where the government was going to be like an owner of the home with you. And I don't mean to put them on the same, but I'm interested to see how the usage of the product is. You can now refinance with CMHC. Now, just to back that up, years and years and years ago, you could do refinances with CMHC. Believe it or not, and this is going to suck for a lot of the newer people, it was so good back in the day. We used to refinance homes up to 95%. CMHC, and they wouldn't even do an appraisal.
Wild.
They wouldn't even do an appraisal.
Yeah.
They literally they use their Emily valuation system internally, and if the estimated amount you put in matched, it green lighted, and you'd get an approval at 95% refinance with no appraisal. So the good old days are gone, and they've been gone for a while. But
I remember getting upset when it went to 820 or 80%. I'm like, that's my money in there.
Yeah. You're stuck leaving 20. So it's always been a thing where you talk to anyone, a mortgage broker, and you say, "Can I refinance your home?" It's always the easy line is, "Well, you got to keep 20% equity in your home."
Right.
That no longer is the case, but there's a caveat to it. So CMHC is back in the refinance game, right? From many, many years of being out. But there's a whole asterisk or 3 asterisks attached to this, and that is that, yes, you can refinance with CMHC now, so I can send in a refinance application. They will refinance your home up to 90% of the estimated new value, because when I say that, it's because the only reason, asterisk, that you can get into this program is you have to be adding another unit to your home.
Now, when you say estimated, don't you mean like an appraisal?
So the appraisal will go into an estimate. So what happens is you got to get all your drawings, you got to get and you're actually going to give that to the appraiser. Appraisers are now going to have to go to your home and value it based on your home value today, plus what it would be like when this extra unit or 2 or 3 that you're putting in the home is done.
So they don't do it at the end?
No.
Oh, they do it at the beginning?
It's all based on estimated at time of completion value.
Interesting.
Yeah. And that's because CMHC is involved. I mean, remember, CMHC also has their automated back-end Emily system, which is an automated, effectively, appraisal system behind the scenes. So they obviously want to get an appraiser, a physical appraiser, to give them the rundown as to the value of the home and what it's going to be like when the unit is added. But then behind the scenes, CMHC can always back check through their Emily system when it gets time to close the deal and just make sure. And if there's a discrepancy, they can always ask for another appraisal, right? CMHC is in their full right to always ask for whatever they want. But at the end of the day, they also still try to streamline things because they're a business and they're trying to get deals in and out as well.
And I don't know if you said this, but that's up to $2 million.
It's up to $2 million, yeah. Right. So, I mean, let's play out a scenario. I got a $1.2 $2 million home in Toronto. I'm going to add 2 units to it. The appraiser comes in and says, yeah, when you add these 2 units, it's going to be worth $1.9 million. So the CMHC, the government, will actually be able to approve you up to 90% of $1.9 million. And certainly that's going to help you repay whatever funds you used to build, because the other thing is they're not giving you the money up front. You know what I mean? Like, that's the other thing too, is they're basically saying, well, we're going to give you the money of this once it's completed. And obviously once it's completed, you get the money. So you will have to put up some money. Yeah,
you're going to have that money as well too. And also too, I think that's important is that also you got to remember, as great as it sounds, your mortgage payments are going to be higher as well too. So you got to keep that in mind.
Yeah, 100%. I mean, these are, it's believe it or not, it's a crazy variation of the Purchase Plus Improvements program, but it's like on steroids. And what I can explain to you is when you buy a home, right? So CMHC has a program where if you and I go buy a home and before we've closed on that property, we bring CMHC some quotes to go, hey, I want to improve this property. I want to do $60,000 in renovations. I can bring that quote to my mortgage broker. He can bring it, or he or she can bring it to CMHC. And CMHC, assuming again that I'm putting in less than 20% down, because remember, it's on a purchase, it's at a purchase, to use CMHC, it has to be less than 20% down payment. Yeah. So in that case, I can now bring that quote to CMHC. If CMHC approves that quote, they will actually add that $60,000 onto my mortgage. But here's the kicker. They don't give you the money. You have to fund the project, and then when it's confirmed that it's been completed, CMHC has your lawyer release those funds to you that have been held back.
Do you see the Purchase Plus Improvement coming back in this particular market?
It should. Yeah, I mean, look, you've got a lot of people. There's, what you're in the real estate market. You tell me what homes are moving the fastest when they're, when the currently
right now it's residential homes. These are people who are looking to move in. Yeah, and it's done.
And it's nicely done. It's probably been renovated in the last 5 to 10 years. Those things move.
Yes.
You know what I mean? The properties, though, you and I know there's a lot of properties out there, though, that are being bypassed by people because they have some wear and tear or they need some work, right? Or it's dated, right? In the last couple of years, because interest rates have been so darn high, you know what I mean, and financing has been so tight, who's looking to get into projects where they're going to go put money into something at super high rates? So that had kind of dwindled. I think as interest rates come back down and more people will be coming to the market, those properties, if they're educated, if the client is educated correctly, and like, look, that's a dated home, but like, if I'm your mortgage broker and you're putting down less than 20%, I can easily get you extra money to fund some of the renovations to make that property now a property that you feel happy about, right? And that you're comfortable raising your family in. You know what I mean? The Purchase Plus Improvement I always thought was an amazing program. I just think the worst part of the program was simply that the client had to come up with the funds to do the work, and then they would get their money after. Because, at the end of the day, I come to you and I'm like, okay, great. They've approved your $60,000 in renos, but they're not going to give you the 60 until you're done. And a lot of the clients always be like, well, where am I getting the 60 grand? Yeah. And if you don't own other properties and I don't have other properties to go and pull equity out of, where are you getting that money? Right. In a perfect world, your mortgage broker's super rich and just lends you the money, but that's not an ideal or realistic situation all the time. So, the reality is they would be borrowing from family. Sometimes they would have the contractor only take 50 or 40% of what's owed and then get paid at the end, so they'd make a deal. But that was kind of how that program got used a lot.
Got it. All right, I want to talk about things that are happening in the market right now today. So interest rates, sorry, not interest, but inflation. Inflation was down at 1.6%.
Yep.
It's now at 2%.
Yep.
People are starting to freak out.
It makes no sense to me.
What are your thoughts on that? Right?
No, there's no one in the world should be freaking out at a 2.0 inflation print.
Yeah, I agree.
Lower than that is very bad for the economy. Overall, long term, 1.6 was nice. It was the thing we needed as I think Canadians to be like, okay, like if you're hitting 1.6, then we're definitely not hitting 7, again in the next like 12 months. So it was kind of like that thing of like, all right, we've beat this high inflation. Doesn't mean we won't get a medium-sized spike at some point in the interim. No one can control that. But I think that was more of a, hey, 1.6, that's good. That's below their target. Went up to 2, and everyone was like, oh my God. Look, It went up to 2. You have to read why it went up to 2. Property taxes. That was a 6% increase. In the data. That's also a once a year thing. Generally, property tax increases. Right. So that was just a misnomer on the month, right? You also had, believe it or not, shelter costs increasing again because we still have rent wars going on in the world today, in a lot of areas. And obviously, the cost of living is, in terms of shelter, is a big component of inflation, and it's growing as well.
Yeah, and I think the big thing as well too now, and I remember even when we started first Smart Home Choice, and I would talk to people about inflation. Like, hey, you know what inflation is? People they knew the word, but they never knew what the amount was, right? But now people are so educated. over sensitive now,
yes,
with inflation. So they're looking at every single thing about inflation and where that number is. And if it goes to 2.2, oh my God, the sky is falling. Yep. And what you're saying is like we're hovering where we need to be. So we're fine.
We're fine. Listen, you want to sound the alarm bells. If we see like 2.6, 2.7, and it starts growing, then I'd be like, okay,
yep.
That's something I would be that would be something you really want to open your eyes at and make decisions based on potentially inflation continuing to go up. But I think I think we stay in the 1.5 to 2.5 range for quite a while. And look, the government's not doing us any help at the moment. The idea of giving everyone, that's made under $150,000, $250 might seem noble and everything, but there's not an economist in the country that's going to tell you that's the good for us. Believe it or not, it's inflationary.
For sure. And I do want to get into that later on in another part of today's show. But yeah, you're right, though. I think where we are right now does make a lot of sense. Now, the other thing that there was a lot of concern with earlier this year was the mortgage renewal cliff.
Yes.
Is that cliff still there?
Yep.
It is still there?
Yeah, it's big. I mean, you have the most amount of, you have a very concentrated amount of people renewing their mortgages at low interest rates to high interest. And let's make it clear, they talk about this renewal cliff, and I mean, if you take away the low interest rates from 2021 and 2022, and even parts of 2020, you're always going to have every 5 years or so, like every year there's going to be people that are having to renew their mortgage from the 5-year term they took. Really, this big cliff is that in 2020 and 2021, 2022, there was a lot of mortgages done. People that, had higher interest rates were obviously refinancing and getting into lower rates. We also know that the most amount of homes were purchased during that 2.5-year period, and out of any 2.5-year period our country's ever seen. So the idea is just simply behind that is that 2025, 2026, 2027, a lot of renewals are coming up, but more importantly, they're coming out of low interest rates. And that's the worry when we talk about the cliff. The cliff is effectively that I've been humming along at 2.79 for 5-year fixed, and all of a sudden my renewal comes up and I'm being offered 4.9. Right. And I realized my mortgage payment has just increased drastically. And we saw it last year, the peak in interest rates was last year in October. So October of 2023, if you had signed a mortgage for a 5-year fix in 2018, which at the time probably would have been a good rate, 3.49, you were faced with the decision of taking a new 5-year fix at like 6.79. Like it was,
which is huge.
And you look at the interest on that you're paying, and it's in terms of aggregate interest overall, and you're like, that's incredible. So, that's why, if hopefully you're working with a sophisticated and educated broker or banker that was going, no, we're not signing a 5-year fixed at the height of the market. We're going to look for a 1 year. We're going to look for something, or a variable, something flexible that when interest rates come down, you're not going to be tied up in some long-term mortgage that has massive penalties, and you'll actually be able to take advantage of the lower rates when they come.
Now, have you seen any of the banks do anything for clients where they are in a low interest rate? They're about to go into a larger or higher rate to extend the amortization, and maybe kind of doing it in the background and not.
Yeah, we've seen it. You got to ask for it. I've seen it. I mean, so I've heard of it. And remember, because on a renewal, if you're my client, but you renew with your existing bank, I'm not privy a lot unless my client's sharing it with me in terms of showing me the documents. Right. I'm not privy to everything that's going on, but I am obviously in our teams that I run we always try to stay in touch with our clients during renewals. Even if they're renewing with the current bank, I want to still guide them to make sure that they're doing the right thing. So we have them send us their paperwork and everything.
Yep.
Look, we've seen banks, if you request it, they can and sometimes have the ability to put you and reset you back to your original amortization. So yeah, we've seen that happen a lot. And I've seen on variable rates, people that are hitting their trigger rates. I mean, the banks do seem willing and able to work with you to help make, some people are calling me going, my amortization is about 108 years left to pay off my mortgage, because they were in a low variable rate that wasn't moving. Right? Well, it looks bad, but when your renewal comes up, it's very easily you can get your amortization back. I mean, amortization can be manipulated. I don't mean that in a bad way. I mean, when my renewal comes up, I can just change my amortization to higher or lower, therefore manipulating the payment. It's nothing wrong with that. That's just a part of the process. But so you can do the same thing with the variable rate when it comes up for renewal as well. Awesome.
All right, listen, Dave, I'm going to wrap this one up.
Nice.
This is part one of part two. We're gonna jump into all the government incentives that they've been doing lately. I want to dive into your Dave Butler 100 program as well too, and some of your predictions and recommendations moving into 2025. All right, so with this one here, we're going to wrap this one up. If anybody wants to get a hold of you, what's the best way to do it, Dave?
DaveButler.ca. Hit me up.
All right, awesome. Thanks, Dave. Appreciate it.